The Federal Reserve just crossed a threshold that in 40 years of watching central banks navigate impossible choices has only been crossed 3 times. And each time it was crossed, gold entered what market historians call the final phase. Not the rally, not the spike, the final phase. The one that turns patient accumulation into generational wealth transfer. On March 18, 2026, Jerome Powell held rates at 3.50% to 3.75%, while inflation ran at 3.1%, oil traded at $100 per barrel, and GDP growth had collapsed to 0.7%. That is not a policy decision. That is paralysis, and paralysis is the signal. Here is what most investors missed while watching the press conference. The Federal Reserve did not choose to hold rates. The Federal Reserve was forced to hold rates because every other option had become mathematically impossible. Cut rates into a live oil shock and reignite inflation that is already 55% above target. Raise rates into a slowing economy and detonate the $9.2 trillion debt refinancing wave that is already costing $1.03 trillion annually in interest payments. There is no third option. The trap is complete. And gold, which has been pricing this trap for 6 months while retail investors watch the daily volatility, is now entering phase 3, the phase where the short-term mechanical price and the structural price converge violently. The phase where central banks that have been quietly accumulating at double the historical average for 3 consecutive years are validated. The phase where JP Morgan's $6,300 target and Deutsche Bank's $6,000 target stop being projections and start being mathematics. Let's be precise about what phase 3 means, because this is not speculation. This is pattern recognition across every major gold bull market in recorded history. Phase 1 is the accumulation phase. Central banks buy. Sovereign wealth funds reposition. Gold rises steadily from $1,800 to $3,200, then $4,200, then $5,589 at the January 2026 peak. The move is consistent but not parabolic. This phase can last years. Phase 2 is the recognition phase. The general market begins to understand why the institutions were buying. A catalyst arrives. In 1979, it was the Iranian Revolution and oil quadrupling. In 2008, it was Lehman Brothers. In 2026, it is the Federal Reserve's March 18th meeting where the central bank that manages the world's reserve currency confirms it has lost the ability to fight inflation without destroying the economy or service the national debt. Phase 3 is the final move. The move that makes everything that came before look like a setup. This is when the mechanism that has been suppressing gold in the short term, rising bond yields, dollar strength, algorithmic selling finally breaks. Not because sentiment changed, because the mathematics of the debt cycle made continued suppression impossible. In phase 3, gold does not rise steadily. It gaps. $200 moves overnight. $500 moves in a week. Central banks that were buying 863 tons per year in Phase 1 and Phase 2 accelerate their purchases because they recognize the window is closing, and retail investors panic buy at prices that make the Phase 1 accumulation levels look like gifts. Phase 3 is where 70% to 80% of the total bull market gains are realized, and the signal that Phase 3 has begun is always the same. The central bank loses control. Here is where things get important. The March 18th Fed meeting was not the beginning of Phase 3. It was the confirmation. Phase 3 began 3 months earlier in December 2025, when the Federal Reserve quietly started creating $40 billion per month in new liquidity under the name Reserve Management Purchases. Not quantitative easing, not stimulus. Reserve Management Purchases. They did not hold a press conference. They did not issue a statement explaining why the central bank that had spent 2 years fighting inflation by draining liquidity was now creating $40 billion per month in new money. They just started doing it. And the reason they started doing it is the same reason the Fed held rates on March 18th instead of cutting them. The system is trapped. The United States must roll over $9.2 trillion in federal debt this fiscal year. At 3.75%, the interest cost is already $1.03 trillion annually. If rates rise to 4.5%, that cost increases by another $69 billion per year. The arithmetic of higher rates against a $36.2 trillion debt load is not sustainable. But the Federal Reserve cannot cut rates openly because oil at $100 per barrel has pushed core PCE inflation to 3.1%, moving in the wrong direction. So the Fed holds rates publicly and creates $40 billion per month in liquidity privately. The banks used that liquidity to buy treasury bonds that the market was not absorbing fast enough, and the system limps forward for another month. This is the mechanism that always precedes Phase 3, the central bank saying one thing publicly while doing the opposite operationally. In 1979, the Fed said it was fighting inflation while M2 money supply was expanding at double-digit rates. In 2008, the Fed said the banking system was sound while creating emergency facilities to prevent bank runs. In 2026, the Fed says monetary policy is data-dependent while creating $40 billion per month in liquidity that the data says should not exist. Gold does not wait for the Fed to admit what it is doing. Gold prices the gap between what the Fed says and what the Fed does. And the gap is now wider than at any point since the 2008 financial crisis. Here's the scorecard that confirms Phase 3 has begun. Gold at $5,100 per ounce as of March 19th after the Fed meeting, holding the structural support level that formed during the Iran war pullback. That support level is institutional accumulation. Central banks bought 863 tons in 2025. They are on pace to match or exceed that in 2026, despite gold being $2,000 per ounce higher than when they started buying 3 years ago. Silver at $82, trading at a gold-silver ratio of 62. Historically, when that ratio compresses below 60 and then snaps back during a Phase 3 move, silver outperforms gold by 3 to 5 times. Mining stock valuations lagging gold by 20% because retail investors have not yet arrived. The GDX ETF lost 20% of its shares outstanding through redemptions, even as gold moved higher. When retail arrives in Phase 3, those shares outstanding expand violently. The US dollar index at 98.6, weakening despite a global crisis that historically would have sent it above 105. A dollar that cannot strengthen during a war when oil is spiking and the Fed is holding rates is a dollar whose safe haven premium is being questioned. Treasury yields holding at 4.14% on the 10-year despite equity market volatility that would normally push investors into bonds. Yields refusing to fall means the bond market is pricing the $9.2 trillion refinancing wave and concluding that the supply of new debt is overwhelming demand. And here is the number that matters most. The Federal Reserve's balance sheet losses have reached $245 billion as of March 2026. The central bank is paying banks 3.65% on $3.3 trillion in reserves, while earning far less on the Treasury bonds and mortgage-backed securities it holds. The Fed is technically insolvent by any private sector accounting standard. The institution that manages the world's reserve currency has been running losses for 3 consecutive years and is holding those losses as a deferred asset. That insolvency does not matter until it does. And the moment it matters is when the market concludes that the Fed will be forced to choose between servicing its own balance sheet losses and supporting the Treasury market. That moment is the Phase 3 catalyst, and the March 18th rate hold, while creating $40 billion per month in hidden liquidity, says that moment has arrived. When the Federal Reserve creates $40 billion per month in liquidity while claiming monetary policy is restrictive, it is managing 2 different realities simultaneously. The public reality, where the Fed must appear committed to fighting inflation, and the operational reality, where the Treasury market requires continuous support to absorb the $9.2 trillion refinancing wave without yields spiking to economy-breaking levels. This dual reality works only as long as the market believes the Fed can eventually reconcile the two. The moment the market concludes reconciliation is impossible, that the Fed will be permanently trapped between inflation containment and debt service is the moment Phase 3 accelerates from a structural repricing into a currency crisis. Here is what separates this Phase 3 setup from every previous one. In 1979, central banks were net sellers of gold, selling 400 tons, trying to suppress the price and defend dollar credibility. In 2008, central banks were cautious buyers, adding 235 tons that year. In 2026, central banks are buying 863 tons per year. That is 3.7 times the 2008 pace. And they are doing it at prices above $5,000 per ounce, meaning each ton costs them $160 million compared to $25 million per ton in 2008. They are not hedging, they are repositioning. The COMEX registered silver inventory has fallen from 190 million ounces in 2020 to 103 million ounces in February 2026. That is a 45.8% decline, while silver prices rose from $18 to $82 per ounce. Physical metal is being drained from the system at exactly the moment when industrial demand from solar installations, EV production, and AI infrastructure is hitting record levels. The paper market can be created infinitely. The physical market cannot. And when the divergence becomes too extreme, the paper market breaks. Suddenly, violently. Here is the detail that confirms the mechanism is already breaking. Look at what happened in the Treasury market during the week of March 17th through March 21st. The 10-year yield opened Monday at 4.08%, climbed to 4.25% by Thursday after the Fed meeting, then inexplicably dropped back to 4.14% by Friday close, despite no material change in the economic data. That is intervention, the $40 billion per month in reserve management purchases flowing into the market, exactly when yields threaten to break above 4.30%. The market is being managed, not stabilized, managed. And the difference between those two words is the difference between a central bank that is in control and a central bank that is desperately preventing a specific outcome while pretending the system is functioning normally. That is the mechanism breaking in real time. And gold is pricing it. The $5,100 support level is the price level where institutional buyers concluded that the Fed's management of the Treasury market had crossed from temporary crisis response into permanent market intervention. They saw it in 1979, when the Fed tried to manage inflation without raising rates aggressively and lost control. They saw it in 2008 when the Fed tried to manage the housing crisis without admitting the entire banking system was insolvent. And they're seeing it now in 2026. The pattern is identical. The scale is larger. The Fed will continue managing the Treasury market through hidden liquidity creation until the market forces a choice. Admit the system is being managed and formalize the intervention through yield curve control, or allow yields to spike, trigger a sovereign debt crisis, and deal with the economic collapse that follows. There is no scenario where the Fed simply stops creating $40 billion per month in liquidity, and the Treasury market magically absorbs $9.2 trillion in refinancing at 3.75% rates without intervention. Foreign buyers have been net sellers for 3 consecutive quarters. Domestic buyers are already saturated. The only buyer of last resort is the Federal Reserve itself. That transition is Phase 3, not the price of gold hitting a new high. The transition from a monetary system where central banks respond to markets to a monetary system where central banks control markets to prevent outcomes they cannot afford. Gold has been the hedge against that transition for 5,000 years. When the Fed creates $40 billion per month in new dollars, gold does not create $40 billion in new supply. Annual gold mine production is approximately 3,000 tons globally. Annual central bank purchases in 2025 were 863 tons. That means central banks alone absorbed 28.7% of all newly mined gold last year. The structural price is being set by the 863 tons of central bank buying that continued through the volatility, through the Iran war, through the Fed meeting, without interruption. Poland added 90 tons in 2025. Singapore added 73 tons. China's official purchases totaled 295 tons. India added 77 tons. Turkey added 75 tons. These are multi-decade portfolio allocations being executed by institutions that manage their reserves across generations. And here is what makes the current moment different from every previous Phase 3 setup. The private credit sector. There is $4 trillion sitting in private equity and private credit funds, with $440 billion in zombie funds that are more than 10 years old and cannot exit their positions. When the credit cycle turns, when defaults begin rising, those losses will be forced into the open, and the banking system that lent to those funds will need support. And the only tool the Fed has is the one it is already deploying at $40 billion per month: print money. When the speculative market realizes that the structural buyers have been accumulating at every dip, the speculative market will reverse, not gradually, violently, because the traders who sold gold at $5,200, expecting it to fall to $4,800, will be forced to cover their short positions when gold breaks back above $5,400. That momentum is the mechanical result of a market where the structural bid has been absorbing supply at lower prices, while the speculative market was betting on further declines. This is the Phase 3 mechanism. The speculative market creates volatility. The structural market uses that volatility to accumulate. Then the speculative market realizes what happened and reverses violently. The Federal Reserve continues creating $40 billion per month in liquidity while holding rates publicly. But currency traders see the liquidity creation. Foreign central banks see their dollar reserves being quietly debased. And they accelerate the process they started 3 years ago, shifting reserves from dollars into gold. That shift creates a feedback loop. More central bank gold buying pushes prices higher. Higher prices validate the thesis. Validation brings more buyers. By the time retail arrives, gold is at $7,500, and the conversation has shifted from whether gold should be owned to how much gold should be owned. The dollar weakens as reserve diversification accelerates. The Fed faces the same impossible choice it faced in March, but worse: cut rates and admit the inflation fight is over. Hold rates and watch the economy slide into recession. Raise rates and trigger the sovereign debt crisis that every institutional investor has been positioning for since 2023. The choice the Fed makes does not matter. Gold wins in all three scenarios. A rate cut is open debasement. A rate hold is hidden debasement. A rate hike is debt crisis. The only variable is the speed, not the direction. And here is the layer that most analysis misses: the incoming Fed chair succession in May 2026. Kevin Warsh takes the chair with a mandate from a president who has publicly demanded rates at 1% or lower. Either Warsh cuts rates despite oil-driven inflation at 3.1%, confirming that Fed independence is gone, or Warsh holds rates, confirming the stagflationary trap is real. Both scenarios lead to the same place. Here is what the historical record shows about Phase 3 timing. The 1970s gold bull market entered Phase 3 in 1978. Gold went from $200 in 1978 to $850 in January 1980, a 325% gain in 18 months. The 2000s gold bull market entered Phase 3 in 2008 when Lehman collapsed. Gold went from $800 in October 2008 to $1,220 in September 2011, a 140% gain in 3 years. The 2020s gold bull market entered Phase 3 in December 2025 when the Fed started creating $40 billion per month in liquidity while claiming monetary policy was restrictive. Gold is at $5,100 today. JP Morgan's $6,300 target represents a 23.5% gain. Deutsche Bank's $6,000 target represents a 17.6% gain. If the historical pattern holds and Phase 3 produces 140% to 325% gains from the entry point, gold reaches $10,200 to $14,400 by 2028. Those numbers sound impossible to investors anchoring to the current price. They are not predictions. They are pattern recognition. Phase 3 has produced those returns in every prior cycle because Phase 3 is when the monetary system breaks And gold is the only asset without a counterparty that can break. No central bank, no government, no promise that can be defaulted on, just metal. One type of investor will wait for confirmation. They will wait for gold to break above $5,589 and make a new all-time high before buying. They will wait for the financial media to confirm the trend. They will wait for their financial advisor to recommend an allocation. And by the time all of those confirmations arrive, gold will be at $7,200 and the Phase 3 entry point will be gone. The other type of investor recognizes that Phase 3 does not announce itself with a press release. It announces itself with the central bank trap becoming mathematically undeniable. The $9.2 trillion refinancing wave is not speculation. The $1.03 trillion annual interest cost is not speculation. The $40 billion per month in liquidity creation that the Fed is not publicizing is not speculation. The 863 tons of central bank gold purchases in 2025, despite record high prices, is not speculation. Those are facts. And those facts say the central bank has lost control. Phase 3 is not coming. Phase 3 is here. The question is not whether to position. The question is whether to position at $5,100 or wait and position at $7,200. After the confirmation everyone is waiting for has already arrived and priced the opportunity out. Most investors will not understand the difference until it is too late. Now you do.